Stop everything. Your bank is required to hold exactly 0% of your deposits in reserve. Not 10%, not 5%, not even 1%. 0. This is not a conspiracy theory. This is not financial doom porn. This is Federal Reserve Regulation D, Section 204, effective March 26, 2020. And what almost nobody understands is that this was sold to the public as a temporary emergency measure during COVID. 6 years later, it's still in effect. The Federal Reserve has quietly extended it multiple times without public announcement. And the banking system has become so addicted to operating with zero reserves that returning to any reserve requirement would trigger immediate liquidity crises across hundreds of institutions. Asian guy here, Johnny G. It's late. And what I'm about to walk you through is not speculation. This is documented regulatory reality that exists right now, governing every single dollar you have sitting in a checking account, savings account, or money market fund at any bank in the United States. The Federal Reserve eliminated reserve requirements entirely in March 2020. The official justification was that the economy was in free fall due to pandemic lockdowns, and banks needed maximum lending capacity to prevent a credit freeze. Fair enough, that was the emergency. But here's what they didn't tell you then, and what they're still not telling you now in 2026. Once you eliminate reserve requirements, you cannot bring them back without breaking the system. Because banks immediately used that freed up capital to make loans, buy securities, and leverage their balance sheets to levels that are only sustainable if reserves stay at zero. The moment the Fed tries to reinstate even a 3% reserve requirement, hundreds of regional banks would face instant liquidity shortfalls. They would be forced to sell assets at losses, call in loans, or seek emergency funding. The Fed knows this. The banking industry knows this. And that's why what was supposed to be a 90-day emergency measure has now been quietly extended for 6 years and counting. Let me be very clear about the mechanics here, because this is the foundation that determines whether your savings are actually safe or whether they are just a liability on a balance sheet that can't be honored when stress hits. Fractional reserve banking means banks hold a fraction of deposits as reserves and lend out the rest. Historically, that fraction was 10% for large banks. So if you deposited $100, the bank kept $10 in reserve and loaned out $90. That 10 buffer was your protection. It meant that if 10% of depositors showed up to withdraw money simultaneously, the bank could meet those demands without selling assets. But at 0% reserves, there is no buffer. Your entire $100 deposit is immediately redeployed. The bank loans it, invests it in bonds, uses it as collateral for derivative positions, or parks it in overnight repo markets. The cash does not sit idle. And that means if you and everyone else with deposits at that bank decided to withdraw on the same day, the bank would have $0 in liquid reserves to meet those requests. They would need to liquidate assets instantly. And in a stressed market, liquidating assets means taking losses. Those losses eat into capital. And once capital falls below regulatory minimums, the FDIC steps in, and the bank is finished. Now let me show you why this matters right now in February 2026, and not just as a theoretical risk. According to the Office of Financial Research, U.S. banks are sitting on approximately $481 billion in unrealized losses on their securities portfolios as of the end of 2024. That number represents nearly 20% of the aggregate equity held at banking subsidiaries nationwide. What that means in plain English is that 1/5 of the capital cushion that's supposed to absorb losses in the banking system exists only on paper. It's trapped in bonds that banks bought during the zero-rate era when treasuries yielded 1% or 2%. Those bonds are now underwater because rates have risen. A 10-year treasury yielding 1.5% is worth significantly less when new 10-year treasuries are yielding 4.5%. The banks haven't sold those bonds yet, so the losses are unrealized. They don't show up on income statements. But they're sitting there, waiting. And the moment a bank needs cash fast, the moment depositors start withdrawing at scale, those bonds have to be sold. And selling turns paper losses into real losses. This is not hypothetical. This is exactly what killed Silicon Valley Bank in March 2023. SVB had $173 billion in deposits and a massive securities portfolio with unrealized losses. When their venture capital depositors started pulling money, SVB was forced to sell $21 billion in bonds to raise cash. They realized a $1.8 billion loss on that sale. That loss wiped out a significant portion of their capital. The market saw it. Depositors panicked. And within 48 hours, the bank was dead. The second largest bank failure in U.S. history. The FDIC stepped in. Depositors above the $250,000 insurance limit were bailed out by emergency government action. But the mechanism of death was clear. Zero reserves plus unrealized losses plus deposit flight equals instant insolvency. And here's the terrifying part. SVB was not an outlier. According to Florida Atlantic University's banking screener, as of Q2 2025, there were still 16 banks with unrealized losses equal to 50% or more of their common equity Tier 1 capital. That means these institutions have paper losses so large that if they had to realize them, half their capital cushion would vanish. They are one confidence shock away from SVB's fate. Now layer on top of this the commercial real estate crisis that is building across the United States right now. Office buildings, retail centers, even multifamily properties. Vacancy rates are rising, property values are falling, and over $1.5 trillion in commercial real estate debt is maturing in 2026 and 2027. Most of that debt cannot be refinanced at current interest rates without borrowers injecting massive amounts of new equity. Many borrowers don't have that equity, so they default, they hand the keys back to the lenders. And who are the lenders? Regional banks, community banks, the same institutions that are already carrying $481 billion in unrealized securities losses and operating with zero reserves. When those commercial real estate loans start defaulting at scale, the losses flow directly onto bank balance sheets. And when depositors see rising loan loss provisions in quarterly earnings, when they see headlines about commercial real estate stress, they start moving money, not because they're irrational, because they're paying attention. And here's where the zero reserve requirement becomes the accelerant instead of the safeguard. In the old system, with 10% reserves, a bank facing moderate deposit outflows could meet those requests from reserves without needing to sell anything. The 10% buffer bought time. It allowed the bank to communicate with depositors, to show strength, to negotiate with regulators if needed. But at zero reserves, there is no time. The first dollar of outflow forces an asset sale. And once asset sales start in a stressed market, the death spiral begins. Sell assets at a loss, realize the loss, capital falls, confidence erodes, more depositors leave, more asset sales required. Bigger losses, lower capital, regulators arrive. Game over. This is not a slow-moving crisis that unfolds over quarters. This is a 48 to 72-hour event. And the zero reserve requirement means it happens faster and with less warning than any crisis in modern banking history. Let me now connect this to something that happened 2 weeks ago that barely made the news, but should have been a front-page alarm. On a Friday night in late January 2026, Illinois banking regulators closed Metropolitan Capital Bank and Trust, small bank. Total assets around $261 million. The FDIC took it over through what they called a routine resolution process. Normally, a bank this small failing would be local news, footnote material, but the timing was not normal. Metropolitan Capital Bank failed on the same day that gold and silver prices experienced one of their steepest single-day declines in decades. Bitcoin got crushed. Stock markets globally were in free fall. This was not a coincidence. This was a liquidity event. Forced liquidations across multiple asset classes simultaneously. And Metropolitan Capital Bank, operating with zero reserves, got caught in the crosscurrents. They needed cash. They couldn't raise it. Regulators stepped in. First bank failure of 2026. The FDIC estimated the loss to the Deposit Insurance Fund at $19.7 million. That number is pocket change in the context of the overall banking system. But it's a data point. It's proof that even in early 2026, with all the emergency liquidity facilities the Fed put in place after SVB, banks are still failing. And they're failing because the structural vulnerabilities, the zero reserves, the unrealized losses, the commercial real estate exposure have not been fixed. Now let me tell you what the Federal Reserve is not telling you about why reserve requirements are still at 0.6 years after the emergency supposedly ended. Because the official narrative is that reserve requirements don't matter anymore under the Fed's current operating framework. They shifted to what's called an ample reserves regime, where they control interest rates by paying banks interest on reserves rather than by managing the quantity of reserves. Fine. That's monetary policy technical detail. But here's the real reason. The banking system cannot function with any reserve requirement above zero without triggering mass failures. Between March 2020 and now, banks have taken every dollar of freed up reserves and levered it. They made loans. They bought bonds. They expanded derivative books. Total assets in the U.S. banking system grew from $22 trillion in early 2020 to over $23.6 trillion today. That growth was funded by zero-cost deposit growth combined with zero reserve requirements. If the Fed reinstated even a 3% reserve requirement tomorrow, banks would need to come up with approximately $500 billion in liquid reserves instantly. They don't have it. They would need to sell assets. And selling $500 billion in bonds or loans into the market in a short time frame would crater prices, realize massive losses, and trigger exactly the crisis the Fed is trying to avoid. So the Fed is trapped. They can't raise reserve requirements without breaking the system. But leaving reserve requirements at zero means the system operates with no shock absorber. Every deposit outflow goes straight to asset liquidation. Every confidence shock becomes a potential bank run. The zero reserve policy was supposed to be temporary. It has become permanent, not because it's good policy, because reversing it would be catastrophic. And the longer it stays in place, the more embedded it becomes, and the harder it gets to ever go back. This is not a policy. This is a dependency. The banking system is now structurally dependent on zero reserves the same way an addict is dependent on the substance. You can't just take it away without withdrawal symptoms that could be fatal. Now let me walk you through the 3 asymmetric positions that make sense in this environment, because understanding the problem is only useful if you act on it. The first position is reducing your exposure to unsecured bank deposits above the FDIC insurance limit. If you have more than $250,000 in any single institution, you are an unsecured creditor. You are not a depositor with a guaranteed claim. You are a lender to that bank. And in a failure scenario, if the FDIC uses its bail-in authority under Dodd-Frank, your deposits above the insured limit can be converted to equity in the failing institution. Which brings me to the second asymmetric position. Physical precious metals, gold and silver held in your direct possession or in fully allocated segregated storage that you control. Not ETFs, not mining stocks, not unallocated accounts, physical metal. The reason this matters in a zero reserve banking environment is that when reserve requirements are zero and unrealized losses are massive and depositors start moving money, the banks with the weakest balance sheets fail first. And when they fail, the contagion spreads. Confidence erodes across the sector. Depositors at other banks start questioning whether their institution is safe. They move money to larger banks, perceived as too big to fail. Or they move money out of the banking system entirely, into treasuries, into money market funds, into physical assets that have no institutional counterparty. Gold and silver have been money for 5,000 years precisely because they have no counterparty risk. When you hold physical gold, you own final settlement. There's no bank that can fail and take your gold with it. There's no government that can convert it to equity in a failing institution. It sits outside the system. And in a banking crisis, driven by zero reserves and mass unrealized losses, that's exactly where you want a meaningful portion of your wealth. The third asymmetric position is being positioned to buy distressed bank assets when the next wave of failures hits, because it will hit. The only question is timing. When regional banks with heavy commercial real estate exposure start recognizing losses, when deposit outflows accelerate, when the FDIC steps in and starts resolving institutions, there will be forced asset sales. Loan portfolios sold at discounts, real estate sold below market value, securities portfolios liquidated to raise cash. The buyers who capitalize on these moments are the ones with liquidity, with cash, or access to credit, who can step in when everyone else is scrambling. This is how fortunes were made after the savings and loan crisis in the 1980s. This is how private equity firms made billions after 2008 buying distressed bank assets from the FDIC. The pattern repeats because the mechanics don't change. Over-leveraged institutions operating on thin capital with zero reserves face a shock. They need cash. They sell assets. And the buyers with liquidity get quality assets at Depression-era prices. The asymmetry is that you're buying from a distressed seller who has no negotiating power. They need to sell. You set the price. Now, let me give you the forward-looking indicators you need to watch because this situation is developing in real time, and the data points that tell you we're moving from stable to unstable are publicly available. First, watch the FDIC's quarterly banking profile. It gets published about 6 weeks after each quarter ends. Look at 2 specific metrics. Unrealized securities losses as a percentage of total equity. If that number starts climbing above 20%, systemic risk is rising, and the number of banks on the FDIC's problem bank list. These are institutions that regulators have identified as being an elevated risk of failure. If that number starts accelerating, it means stress is spreading beyond a few isolated cases. Second, watch commercial real estate delinquency data published by TREP and other commercial mortgage data providers, specifically office loan delinquencies. If that number moves above 12%, you're approaching 2008 crisis levels, and regional banks, which hold nearly 70% of all commercial real estate loans in the U.S., will start reporting material losses. Third, watch deposit flows at regional banks. The Federal Reserve publishes H8 data weekly showing assets and liabilities of commercial banks. If you see sustained outflows from small and mid-sized banks combined with inflows to the largest banks, that's a confidence signal. Depositors are moving money to institutions they perceive as safer. That's the early stage of a run. It doesn't look like people lining up outside a bank. It looks like wire transfers and ACH movements that show up in aggregate data. Fourth, watch the Federal Reserve's emergency lending facilities, specifically the Bank Term Funding Program and the discount window. These are backstops that banks use when they can't access funding in the private market. If usage of these facilities starts climbing, it means institutions are under liquidity stress. The data gets published with a lag, but it's publicly available on the New York Fed's website. And fifth, Watch credit default swap spreads on major regional banks. CDS spreads measure the cost of insuring against a bank default. If those spreads start widening significantly, the market is pricing in higher default risk. It's a forward-looking indicator that traders with real money on the line are getting nervous. These 5 indicators, tracked weekly, will give you more advance warning of systemic stress than anything you'll hear on CNBC or Bloomberg. Because by the time the mainstream media reports a banking crisis, the crisis has already started. The smart money moved weeks earlier based on the data. Let me now address the question that I know is on your mind, because it's the question that determines whether any of this matters. Can the Federal Reserve and the U.S. government step in and bail out the banking system again if another crisis hits? The answer is yes, they have the tools. But the cost of using those tools in 2026 is dramatically higher than it was in 2020 or 2008. The Federal Reserve's balance sheet is still over $7 trillion even after quantitative tightening. Expanding it further means printing more money, which fuels inflation. And inflation is already elevated. The Fed cannot cut rates to zero again without accepting that inflation will accelerate. The federal debt is above $36 trillion. Interest payments on that debt exceed the entire defense budget. Congress authorizing another TARP-style bailout in the current political environment is far from guaranteed. And even if they do, the scale of the problem is bigger now than it was in 2008. Unrealized losses alone are approaching $500 billion. Add in commercial real estate losses, and you're looking at potential system-wide capital needs that could exceed $1 trillion. The tools exist, but using them requires political consensus, fiscal capacity, and public tolerance for bailouts. All 3 are more constrained now than at any previous crisis point. Which brings me back to the zero reserve requirement, because this is the mechanism that makes the next crisis faster, more violent, and harder to contain than anything we've seen before. In 1933, when 9,000 banks failed, reserve requirements existed but were inconsistent and poorly enforced. In 2008, reserve requirements were 10%, and banks still failed. But the failures unfolded over months. Regulators had time to coordinate. The FDIC could step in over weekends and arrange mergers. The system nearly broke, but it held. In 2023, Silicon Valley Bank went from solvent to insolvent in 48 hours. Zero reserves meant zero buffer. One large deposit outflow triggered forced asset sales. Realized losses destroyed capital. Confidence collapsed. And the bank was gone before regulators could arrange a private sector solution. The FDIC had to invoke emergency powers to make all depositors whole, even above the insurance limit, to prevent contagion. They succeeded, but the precedent is now set. The next bank that faces an SVB-style run will have depositors expecting the same treatment. And if the FDIC can't or won't extend that guarantee again, the run spreads. Not just to one bank, to every bank that looks remotely similar. Zero reserves plus unrealized losses plus commercial real estate exposure plus uninsured deposits equals a powder keg, and the fuse is already lit. So here's where we are, stated with the precision the data allows. Reserve requirements have been zero since March 2020. What was sold as a temporary emergency measure has been quietly extended for 6 years and is now effectively permanent because reversing it would break the system. U.S. banks are carrying $481 billion in unrealized securities losses, equal to nearly 20% of system-wide equity. Commercial real estate stress is building, with $1.5 trillion in debt maturing over the next 2 years. The first bank failure of 2026 has already occurred. The FDIC's Deposit Insurance Fund has $128 billion to cover $10.5 trillion in insured deposits, a reserve ratio of 1.22%. That fund is sized for individual bank failures, not systemic events. The bail-in framework under Dodd-Frank is law. It allows the FDIC to convert uninsured deposits into equity during a resolution. This is not a conspiracy. This is how the system is designed to function. And the zero reserve requirement means that when the next shock hits, whether it's a commercial real estate default wave, a geopolitical crisis, or simply a loss of confidence at one large regional bank, the speed of contagion will be unprecedented. Because there is no buffer. There is no time. There's only the decision you make right now, today, about where your money sits and what form it's in when the exits get crowded. This is John A.G. Your bank holds zero reserves. The emergency measure never ended. The system is loaded. And the only question left is whether you're positioned for what comes next, or whether you're still inside a structure that was designed for stability but now operates on dependency, leverage, and hope. Take action. Stay sharp. And I'll see you in the next one.